Hi guys, welcome back to the YouTube channel. Now we're going to have a look at another management accounts decision and control question. So we're being asked to reconcile this statement here. So we've got some figures here about budgeted costs and actual costs. We've got production cans, litres, pounds, direct labour hours and total cost. So there's a few things that we can plug in really quickly here, and that's the standard direct cost of actual production. So if we do open brackets and we take the £2,350 of direct labour costs divided by the hours that we budgeted for, and then times that by the actual hours. That's one element of this. And then we're going to add on the £2,900 of budgeted beans divided by the budgeted litres of beans, and times that by the actual beans. So we're taking 2,900 divided by 7,000 times by 6,500. There we go. So next we've got the price variance of beans. So here I'm just going to add in a formula. So what we're going to do is we're going to take the £2,600 of actual beans cost divided by the quantity of actual beans, and then we're going to do a minus, and then we're going to take off the total cost of budgeted beans divided by the litres of budgeted beans, and then we're going to times that by the actual quantity of beans in litres. Next we've got a price usage variance. So we're actually going to put in a little formula here in a second, so I'm going to skip by that just for a minute and go to the direct labour rate variance because that's really easy to work out. So to work this one out, all we're going to do is take the actual direct labour cost, divide that by the direct labour hours, and then we're going to do a little minus, and we're going to take the direct labour total costs divided by direct labour hours, and then we're going to times all of that by the actual direct labour hours, which gives us £89.07. So let's then work out this price usage variance of the beans. So to work this one out is we're going to take the actual production cans of 11,700, and then we're going to times that by the total number of litres of beans that we've budgeted divided by the total budgeted production of beans, as you can see here. And then we're going to take off the actual quantity of beans, and then we're going to multiply all of that by the cost of budgeted beans, this 2,900, divided by the litres of beans. So if we were to do this another way, show you this formula. So we're taking 11,700 and then we're taking 7,000 litres of beans in budget divided by the 12,650 production budgeted. And we're going to times those two together, and then we're going to take off the 6,500 from this, and then we're going to do 2,900 divided by 7,000, so the budgeted cost of beans divided by budgeted litres, and then we're going to times that figure by that figure there, and that gets us to £10.64. I'm just going to leave that up there for you. So here we can see that that is actually adverse because we have used more than we expected. Popping this into the table, and then direct labour efficiency variance. So to work this one out, I've just popped in an Excel formula, but I'm going to take D9, which is the direct labour cost, and then I'm going to subtract the total of D9 again divided by D5. So in other words, the direct labour cost divided by the budgeted production cans, and then I'm going to times all of that by the actual production can total. So basically I'm going 2,350 minus 2,350 divided by 12,650, then times by 11,700. So this is favourable because it's actually cost less than expected. So we can pop that in here, and then we just need to total all of this up, and that's our actual direct cost of production completed in a reconciliation statement. So there you go. If you found the video useful, then give it a thumbs up, and otherwise I'll catch you at the next one.